Hi everyone, good evening. Thank you for taking your time out to attend our webinar today, titled SBPX Lion Global Investors China's Roaring Opportunity. I hope you had your dinner or are having your dinner right now. First of all, let me introduce myself. My name is Timothy and I'm the product owner for the Share Builders Plan. For those of you who have emailed in to rsp@phillip.com.sg, yeah, I'm the one who has been replying your emails. So without further ado, let me introduce our guest speaker for today, Xin Xiang from Lion Global Investors. Sit back, relax, and enjoy the webinar.
Thank you, Timothy, for the introduction. So, good evening, everyone. Thank you for joining us today. I'm Xin Xiang from Lion Global Investors, also known as LGI, and you can call me the ETF guy. So like many of you here, I used to wonder how ETFs worked. I first came across ETFs around 10 years ago when I wanted to use ETFs for my own portfolio. So ETFs are like basically to me like building blocks. They go building blocks, in fact, which you can use piece by piece to build your own portfolio. And they are an extremely useful tool to help investors like you and me gain exposure to proper diversification that used to be exclusive to institutions. So I'm here today, and I realize. So I'm here today to share more about the Lion-OCBC Securities China Leaders ETF that is designed to help investors like you and me gain access and tap into the exciting growth opportunities offered by China, which is the world's second largest economy and the world's second largest stock market. So as the slide here suggests, this ETF is anchored on two themes: foundation and innovation. And what does this mean? Traditional blue chip players have formed the foundation of China's growth. And we are talking about the banks, commodities, and the bread and butter type of sectors and industries. And now all these sectors and companies have been turbocharged by new innovation and are rapidly adopting technology to future-proof their business models. And many of these companies are not just leaders within China, but global leaders in their respective sectors as well. So through the Lion-OCBC Securities China Leaders ETF, you can capture the growth potential of these China leaders that are transforming the world. So as we start, let me first address, I would say, the major question many of you would now have on your minds. In the past few weeks, we have seen huge volatility in the Hong Kong and China equity markets. In fact, Hong Kong and China equity markets fell sharply for this until China's Vice Premier Liu He issued a strong promise in the Financial Stability and Development Committee, also known as FSDC, for policies to boost financial markets and stimulate economic growth on the 16th of March, which was in fact just last Wednesday. And this was a statement that came before the Federal Reserve approved a 25 basis point rate hike on the same day. And to put into context, Liu He is China's top economic policy maker and the top economic advisor to President Xi Jinping. This is also not the first time that Liu He has tried to calm investors' fears following a market sell-off. If we look back in 2018, he also gave a similar interview with the state media saying that Beijing valued the stock market and that helped to calm an equity sell-off back then. The FSDC meeting also concluded the need to boost the economy in the first quarter of 2022. Specifically, continuing economic development was designated as the top priority of the Chinese Communist Party. And if you read our Q4 newsletter for China Leaders ETF, you would have noticed that this was already highlighted in China's December 2021 Politburo meeting. In the past 3 decades, China has delivered almost all its economic growth targets. To achieve its 5.5% economic growth target this year, we expect China to loosen its monetary policies, such as cutting the reserve requirement ratio, also known as RRR, the 1-year loan prime rate, which also known as LPR, and the 5-year loan prime rate, and increase bank loan quota this year after the strong pledge to support its economy. In terms of context, the RRR, which is the de facto lending rate, was already lowered once by 50 basis points on the 15th of December last year. The 1-year LPR was also cut from 3.85% to 3.8% for the first time in almost 2 years in December, and then further cut to 3.7% in February this year. The 5-year LPR was also cut to 4.6% in January this year. And furthermore, on the fiscal policy front, Chinese Premier Li Keqiang also explained that China will beef up its fiscal expenditure by transferring untapped profits from state-owned financial institutions. And this will help increase additional government expenditure by around 2 trillion yuan. And given all these, and based on the domestic consumption alone, it is likely that China can meet and achieve its 5.5% economic growth target. And if we look further into history, in the past 11 years, we will generally notice that after every bad year, when China's government talks about tightening policies in the Central Economic Work Conference, also known as the CEWC, the following year usually will focus on growth-centric policies. For example, in 2011, when China's government talked about controlling inflation. In the following year, on 2012, the year usually will focus on growth amid stability. And this was accordingly reflected in the MSCI China positive returns in 2012. Another example would be in 2018, where China's government talked about deleveraging, which is here. And however, on the following year in 2019, we would then see China's government refocusing to support growth. Through all these trends, I would say, we see the Chinese principle about exercising caution and balance to avoid overheating the economy. And at this moment and juncture, we're witnessing a similar trend again, where China's government is focused on regulatory tightening in 2021, but switch gears this year to refocus on economic growth. The details and policies will be gradually rolled out later this year, but the general direction of supporting growth was already decided in December last year. And this ties in very well with Liu He coming out last Wednesday to reassure investors about the China market like you and me. On a bigger picture, 2022 is also an exceptionally important year for China, with President Xi Jinping seeking a record-defying third term as China's Communist Party leader. So because of that, positive economic momentum will be crucial in pushing this through. And in recent months, we have also seen US inflation hitting a 40-year high and experience America's focus to tighten policies and tackle inflation, especially with its rate hike last Wednesday. In fact, the Federal Reserve is expected to implement 6 more rate hikes and 4 more rate hikes in 2023 until interest rates reach around 3%. However, China is doing the exact opposite, I would say the contrarian opposite, by loosening policies to drive economic growth. So with China's renewed focus on economic stability and policy loosening, the Lion-OCBC Securities China Leaders ETF is well positioned to ride on this new wave by providing exposure to 80 industry leaders across 12 sectors. So now let us talk about why China and why specifically the China Leaders ETF. Today, China is the world's second largest economy. All signs are pointing to the rise of China as the next economic superpower. So in short, China is too big to ignore. If you look at the left chart here, as of 2020, the size of China's economy is at 14.7 trillion US dollars, which is currently second behind the US. China's growth has also been resilient, achieving economic growth, in fact, positive economic growth, even during economic crises, such as the 2009 financial crisis and COVID in 2020. And if we zoom into the history of China's economic growth on the right chart, for a country that started with 0.3 trillion GDP in 1985 to a giant with 14.7 trillion USD GDP in 2020, this is basically growth compounded 11.7% for year on year for 35 years. And since the early 2000s, this gap between China and the US has also been significantly narrowing, with the market expecting that China will surpass the US around 2028. And based on just existing growth estimates alone, China's economy is already expected to overtake the US in 2028. And in the scenario where the yuan appreciates further by 6% from today's exchange rate to 6 yuan per US dollar, China could even surpass the US in 2026, which is 2 years earlier than expected. This means we are around 4 years away from this happening. And not surprisingly, China is expected to lead the world with the highest GDP growth potential in the next few years. And other than being the world's second largest economy, China is also the world's second largest stock market. As of the end of 2020, it is only behind the US and already ahead of Japan. And backed by a growing and resilient economy, there's various catalysts that will drive the long-term equities performance for China. I'll highlight the 4 key catalysts. And the first would be the growth of domestic consumption within China to be the cornerstone of its economy. As of 2020, China already has a middle class of 344 million. And to put into perspective, this is twice the size of the US middle class, which is at 180 million, and larger than the entire US population, which is 324 million. And this number is set and going to keep growing. And within the next 4 years at around 2026, the Chinese middle class is also expected to exceed 500 million, which is 1.6 times the size of the entire US population. And this is also around the time where China's GDP will surpass the US GDP. And with such a booming middle class, rising consumption power within China will be the anchor of its economy. And second, in terms of demographic trends, we're seeing a big shift in China's consumption pattern towards being more service-oriented. And being a service powerhouse is increasingly crucial to build the world's economic growth. In fact, it took centuries for the world to shift from agriculture to manufacturing. And then we are seeing now a radical shift towards services. And this growth in services has transformed the composition of the world's economic production and employment, together with trading patterns. And as the world's middle class, China's middle class disposable income grows, service industries such as financial services, healthcare, insurance, and education will benefit from this. And third, in terms of China's digital economy, it has been growing exponentially. And the pandemic, no doubt, has accelerated this move into a digital world. As seen in the left chart here, China's digital economy grown 4 times from 2011 to 2020, which is around 17% year-on-year growth for 9 years. And on this slide, you can see the growth displayed here for the digital economy participants like internet users, online shoppers, and online payment users. And they have helped China evolve into a digital economy leader today. And looking into the next few years, China's 14th five-year plan, which covers 2021 to 2025, also prioritizes accelerating digital development and building digital China, from creating new advantages in the digital economy to accelerating digital development. So all these in totality will further accelerate industrial digitalization and the deep integration of digital technologies, such as the industrial internet, big data, 6G, and AI into traditional industries such as manufacturing. China has also been active in reforming and opening up its capital markets. And as you can see here, there have been various initiatives, such as the Stock Connect schemes to help attract capital and growth. And all these will help China grow further into a global powerhouse. Capital investment flows into the Stock Connect schemes have also and will also continue to provide technical support for A-shares and H-shares. And in fact, another benefit of investing in China A-shares is the diversification benefits, because they have demonstrated low correlation with the global market. So by allocating and making allocations to China A-shares, you may be able to diversify away some risks. And furthermore, the Chinese renminbi has also been strengthening against the Sing dollar. In fact, the exchange rate rose from around 5.23 in May 2011 to 4.65 as of 28 February last year. So this technically means an appreciation of roughly 12%. And so to summarize, we see a great compelling growth story in China, supported by strong economic fundamentals, solid companies, and also an excellent beta opportunity. So now let me introduce you to the Lion-OCBC Securities China Leaders ETF, where you can gain easy access to 80 China market giants. So in summary, this ETF is a joint collaboration within the OCBC group to help investors like you and me gain access to 80 China market giants. And this ETF gives you access to the 80 largest Chinese companies listed on the Hong Kong Stock Exchange, Shenzhen Stock Exchange, and Shanghai Stock Exchange. There's a full replication of the Hang Seng Stock Connect China 80 index. Its security is also capped at 8%, with each sector weightage capped at 40% to ensure diversification across sectors and individual stocks. And a very important point to highlight here is that this is the first China-focused ETF that will make a distribution in Singapore. So for Asian investors like you and me, we like dividends, and this actually can fit the bill. And if we dive deeper, this ETF tracks the Hang Seng Stock Connect China 80 index that measures the overall performance of the 80 largest companies, Chinese companies, in terms of market cap listed in Hong Kong and mainland China. And through Hang Seng selection criteria, the index methodology filtered an initial universe of 1,900 stocks, made up of 1,400 A shares and 500 Hong Kong listed equities to the 80 constituents you see today. So this is roughly 4.2% of the entire universe. The eligible stocks must also meet geographical criteria, for example, like 50% of revenue from mainland China, and also turnover requirements. For example, the 6-month average daily turnover being more than 20 million yuan. And thereafter, the eligible stocks will be ranked by company market value, with the top 80 selected as the index constituents. And the index will also be balanced quarterly to ensure that you have exposure to the industry leaders that drive China's growth and expansion. There's also an 8% securities weightage cap, which I also covered earlier, and also a 40% sector weightage cap to ensure a diversified portfolio of industry leaders. As we intended for the portfolio to be diversified, there's also a combination of old economy and new economy stocks which will both benefit from the catalysts that drive Chinese equities performance. The portfolio will also include a constituent spread across the Hong Kong Stock Exchange, Shenzhen Stock Exchange, and Shanghai Stock Exchange. As of the end of February, 64% of the constituents are listed in China and 36% are listed in Hong Kong. And since its listing in 2nd of August 2021, the ETF has closely tracked the Hang Seng Stock Connect China 80 index, and in fact enjoyed stable performance despite the overall China's market volatility and regulatory reconfiguration. In fact, between the ETF's listing date of 2nd August 2021 to 28 February 2022, the index has outperformed all other reputable peer indices, such as the MSCI China Index, the MSCI Emerging Markets Index, and the Shanghai Shenzhen CSI 300 Index. Within the same period, the ETF also outperformed other China-focused ETFs listed within SGX, such as the X-Trackers MSCI China UCITS Index and the Lixor China Enterprise UCITS ETF. And in fact, if we even compare to China-focused active funds within the same period, the ETF actually also outperformed them, such as for example, some of the funds we outperformed, for example, would be the UBS Lux China Opportunity Equity Fund, the Fidelity China Focus Fund, the Aberdeen China Asia Equity Fund, and also the Goldman Sachs China Equity Fund Investor Plus. So these active funds, in fact, they have management fees of more than 1.5% per annum, compared to our China Leaders ETF, which has a management fee of 0.45%, I think just a small fraction. And so, in fact, by being an investor in our China Leaders ETF, you will be paying less fees for better and more stable performance. And such resilient performance can be attributed to the index exclusion of American depository receipts, also known as ADRs. So because of that, this reduces exposure to the foreign regulatory risks that have placed heavy pressure on the US-listed companies such as Alibaba, Baidu, DiDi, and NIO. In fact, given the boiling China and US tensions recently, there have been numerous predictions that most Chinese companies listed on the US exchanges will likely delist from the US by 2024. So by providing diversified exposure to 80 industry leaders across 12 sectors, the Lion-OCBC Securities China Leaders ETF is less vulnerable to foreign regulatory risks and better positioned towards stability and resilience. And if we look further at the top 20 constituents, we also see many household names that are consistently industry leaders. For example, Ping An Insurance, Guizhou Maotai, ICBC, which is the world's largest bank, Tencent, and BYD. And among these constituents, Guizhou Maotai was the favorite drink of China's founding father, Mao Zedong, who served it at state dinners when former US President Nixon visited China back in 1972, which is around 50 years ago. And since then, it has been the brand of choice for elites at business banquets and considered a status symbol because of its premium price and limited supply. And globally, it is the world's largest liquor company by market cap, bigger than Diageo and Constellation brands. And a fun fact, it is also larger than Coca-Cola and Pepsi, which have long held the crown of one of the world's largest beverage makers. And being valued at 2.14 trillion yuan as of yesterday, or roughly around 340 billion USD, Guizhou Maotai is larger than Toyota, larger than Nike, larger than Disney, and as well as being larger than the 4 largest banks within China. So imagine the scale of a liquor company for it to be larger than the world's largest bank. Another constituent, which is Tencent, in fact, just reported its Q4 earnings earlier today. On an IFRS basis, the operating profit, which was around 17.21 billion, and showing an increase of 72% year on year, with operating margin increasing to 76% compared to 48% last year. Profit for the Q4 period was also around USD 15 billion, being an increase of 61% year on year, with net margin increasing to 66% compared to 44% last year. On a whole year basis, Tencent's total revenues was around 87.8 billion, being an increase of 16% compared to 2021. So this means that despite a challenging year in 2021, especially for tech companies, Tencent's revenues still managed to increase. And on an ESG front, Tencent also announced its commitment to achieve carbon neutrality in its own operations and supply chain and use green power for 100% of its electricity consumption by 2030. And in fact, according to Ma Huateng, who is the Tencent's chairman and founder, and also CEO, despite all the financial headwinds it has faced, Tencent has continued to make strategic progress, including driving widespread adoption of its enterprise software and productivity tools, increasing content creation and consumption in Tencent's video accounts and expanding its gradually. And another constituent, which is CATL, is the world's largest EV battery manufacturer, supplying batteries to powerhouses such as Tesla. And another little fun fact, as of February 2022, which is just last month, its founder's net worth, its founder is Robin Zeng Yujun, is already at almost 48 billion US dollars, officially overtaking Li Ka-shing in May 2021. So because of that, in fact, as you and I speak, we are witnessing a symbolic moment in the clean energy and innovation boom. So to summarize, I want to take this opportunity to emphasize that we are positive on the No, sorry, I was disconnected. So, okay, let me share screen again. Okay. Let me see the questions. Okay, I see a question about our view about an outlook about Chinese equities. So I would say, okay, our view on Chinese equities remains positive in 2022 because the China's government focus on economic growth in 2022 as suggested by the use of stability in the CWC back in December 2021. And also, we also see that China is also on an easing cycle, quantitative easing cycle compared to other major economies such as the US, Europe, and Japan. And third, in terms of relative valuation, after the underperformance in Chinese equity markets in 2021. So the base case, I would say, is China would defend its 5.5% GDP growth target by using monetary policy tools, such as triple R cuts, interest rate cuts, and increasing lending quotas for banks. And they could move, in fact, to relaxation of property regulations and fiscal spending at a later stage. And this will have greater positive impact on the stock market. And that being said, I also want to highlight that there might be short-term worries that have weighed on the Chinese stock market. And the recent sell-off in the Chinese equity market could be due to speculations that China might take the side of Russia, the risk of Chinese ADRs being delisted, as the US SEC rules on auditing might come into force soon, and the impact of zero COVID policies on provinces and cities such as Shenzhen and Shanghai, which has allowed lockdowns from increasing COVID cases. And on the Russia issue, the Chinese, in fact, has been distancing themselves from the Russians by using more neutral statements. And given the strong reactions by the US, the UK, EU, and Japan, and Australia, in fact, it is unlikely that China would want to risk secondary sanctions by these countries. And Russia also as a whole, as a trading partner, is also much smaller than the US or the UK, or even the EU. So because of that, it would be irrational, in fact, for China to choose the side of Russia in the Ukraine war. So because of that, our base case, I would say, is that the risk of Chinese assets facing secondary sanctions from a wrong political choice by China will be low. And in fact, the US SEC has also released the names of the first bill and approved for Foreign Companies Accountable Act in March this year. And China's CSRC also issued a statement recently stating that the collaborative arrangement that meets legal and regulatory requirements of both countries can still be made. And in fact, the positive attitude could provide for some count for ADR stock prices, but the delisting risk still remains, and the risk can still weigh on stock performance of Chinese ADRs. So in terms of the Chinese resolve to maintain their zero COVID policy, has also been shown by their recent lockdowns in Shenzhen and Shanghai, which are important ports and manufacturing hubs. So disruptions to supply chains could also happen from these lockdowns. Consumption might also slow, and with more lockdowns might happen when the COVID pandemic spread across to other parts of China. But that being said, the Chinese government still has a lot of policy tools at their disposal to defend the 5.5% economic growth target, although we could still see short-term volatility before the Chinese government announces more supporting measures. Okay. So in terms of the next question I see here is, how can China still achieve its 5.5% economic growth target? So China recently, in fact, concluded its 2022 National People's Congress. So in his last and final press conference, Chinese Premier Li Keqiang explained that China will beef up fiscal expenditure by transferring untapped profits from state-owned financial institutions. And all these will help to increase additional government expenditure by around 2 trillion yuan. And although the recent Ukraine war has added some uncertainty to the global economy, we expect the global supply chain to improve further as the result of the diminishing impact from COVID-19. And as such, strong support from external demand is likely to normalize this year. And so because of all these, the key in fact would be on whether China can achieve its economic 5.5% growth target will largely depend on domestic demand, such as infrastructure investments, property activity, and private consumption. And we expect infrastructure investment to lead the recovery for the first half of 2022. But that being said, it also requires property activity to stabilize around mid-2022 in order to support this growth momentum. And if private consumption can catch up in around the second half of 2022, it will support China's position to achieve its roughly 5.5% economic growth target. So to summarize it as a whole, the ideal recovery path will be strong infrastructure investment in the first half of 2022, and then a stable housing market in the mid of 2022, and the recovery of private consumption in the second half. Okay. I see a question on why is Alibaba not in the index. Basically, it's because it is an ADR. So because of that, it's not part of the index. And because of that, in fact, I would like to take this chance to highlight that the index, when we were constructing it, we specifically excluded ADRs. So because of that, in terms of the performance, you see here where we outperform the other peer ETFs. It is also precisely due to the reason when we excluded ADRs. So in order to for it to be exposed to lower foreign regulatory risks. Okay, let's see. Okay. Okay, I see a question about how many stocks are there in the Hang Seng Stock Connect China 80 index. And in fact, some of the stocks, there have been some overlaps, such as Tencent. So in fact, for this question, so for this question, okay. So in terms of the number, okay, the number of stocks in the China, okay, how many overlap stocks are there between the Hang Seng Stock Connect China 80 index and the Hang Seng Stock Connect, but Hang Seng Tech Index? So okay, as of end of last month, there are around 6 overlap stocks between the China Leaders ETF and the Hang Seng Tech ETF. They are basically Tencent, which one of the audience already correctly pointed out. There's also Meituan, Xiaomi, JD Health, Alibaba Health, and JD.com. So in fact, as of the end of 28 February 2022, the aggregate total weights are respectively being 13.4% in the China Leaders ETF in terms of the overlap constituents, and 36% in the Hang Seng Tech ETF. Timothy, I think I see the questions are mainly addressed already. So Timothy, maybe I'll hand over the time back to you in terms of maybe you want to share more about the Foyum's platform.
Sure. Thanks so much, Xinjiang. Yep. Thank you very much for your very insightful sharing. Yeah, so I think everyone can now tap onto this China Leaders ETF. And like I mentioned earlier during our technical issues, was that if you want to hop on to this wave and this wave of China growth, and you want to do it by doing dollar cost averaging, can sign up for our share builders plan and invest from as low as just $100 a month. Yeah. So Xinjiang, maybe let me share my screen for a while.
Yeah, sure. Okay.
Right. Okay. So like I mentioned earlier, you can contact us at any of these avenues, rsp@phillip.com.sg. Right. So once again, I will show you how you are able to subscribe to the share builders plan and select China Leaders ETF as part of your investment instructions. So I'll recap again. For the top QR code, you just scan this QR code, you log into your Poems account, submit your investment instructions. For the second QR code below, you can just print out the gyro form, and do note that the banks require the original gyro form with pen signature. So you can either mail it to us at this address, or you can pass it on to any of our Phillip Investor Centers. So once again, thank you all for attending this webinar. I wish you all a good night, and yep, I think that's all for today. Thank you.
Okay. Thanks, Timothy, and thanks everyone. Have a great evening.
Okay, bye-bye.
Bye-bye.